Hello everyone, welcome to the 175th episode of me learning how to trade in Forex. So in the last episode we finished off the using trading and investment products lessons with is combining trading and investing right for me? So because of the risk involved, a strategy that combines both trading and investing is not for everyone. So it's important to have a strong financial foundation before adding leveraged products to your portfolio, and you should also make sure that you have the financial stability to withstand the increased risk of loss when you add derivative products to your portfolio. So to know if this strategy is right for you or not, you could consider the following. If I lost my income, I'll be able to pay my living expenses for at least 3 months. If I got into an accident or something happened to my belongings, I have the right short-term and long-term insurance to deal with the financial impact. I have long-term savings specifically set aside for my retirement. I've taken advantage of all the tax-free or tax-efficient investment allocations available to me. I have an appropriate long-term investment strategy suited to my financial goals and needs. Then we went through the lesson summary. So, your success in both trading and investment products will depend on how well you understand the correlation between the shares you own in the long-term portfolio and those you prefer to trade instead. So look at how different asset classes correlate to one another, and then we went through lesson summary. So now, let's start off doing the quiz to finish off this lesson then. So, which one of the following financial instruments is a derivative product? So a derivative product is something that copies the price of the underlying asset, or takes its price from the underlying asset. So individual shares, not really a derivative. Commodities, not really a derivative. Bonds, not really derivative, so it must be contract for differences. Biggest holding in your long-term share dealing portfolio releases disastrous year-end fiscal results. The biggest holding in your long-term share dealing portfolio releases disastrous year-end fiscal results. The company's share price drops 10% overnight. Had you have shorted the same share using a CFD before this happened, you would have lost your money in your share portfolio but earned money in your leveraged trading position. Earned money in your share portfolio but lost your money, well, you definitely didn't earn money in your share portfolio. Lost money in both your share portfolio and leveraged trade. No, you would have lost your money in your share portfolio but earn money in your leveraged trading position because you shorted it. You own a few shares in a popular UK oil company. You read about an upcoming environmental policy in the UK that will introduce heavier pollution penalties for oil companies. To ensure that your overall portfolio stays in the black, you don't buy more shares in the oil companies. You don't sell your existing shares. Take short derivative position on the oil company, take long derivative position. You take a short derivative position on the oil company. You hold shares in an international transport company. You've also opened a long CFD position in Brent crude oil. If the price of oil suddenly shoots up, what could happen to your combined investment and trading portfolio? So if the oil price goes up, so that means oil must be in short demand if the price for it goes up. So if the price of oil shoots up, so your shareholding, you own shares long CFD, so you definitely profit from the CFD position will appreciate in value, yep. Shareholding will appreciate or shareholding depreciate. How does oil and transport correlate? If oil goes up, does transport increase or decrease? How would you decide this? If oil goes up, so how does oil and transport relate to one another? So if oil prices goes up, then it will be more expensive for the transport company to fuel their vehicles. So if it's more expensive for the company to fuel their vehicles, then that would mean they make less profit from doing the transport itself, right? Because the fuel is part of their expenses, so if there's more expenses, then there's less profit to be had or to be obtained. So if there's less profit to be made, then that means investors aren't really going to be attracted to a company not making that much profit, so their shareholding would depreciate in value. You hold shares in Netflix, which is priced in USD. You think that the value of your currency, the British pound sterling GBP, will appreciate against USD soon. So it's going to take more USD to get 1 GBP. This could result in some losses if you sold your Netflix shares after this happens and converted them back to your home currency. You also don't want to sell your stake at the moment because your analysis found that the Netflix may experience major gains in the coming weeks before a sell-off is likely to occur. So you hold your stock. In this situation, which of these CFD positions would you open to manage your currency risk? So you hold shares in Netflix, which is priced in USD. You think the value of the currency GBP will appreciate against USD soon. So if it takes less USD to get 1 GBP, if it takes more USD to get 1 GBP, and you still want to hold your Netflix position, which is priced in USD, so USD is going to fall in value compared to GBP. If USD is going to fall in value compared to GBP, then you'd short USD, right? Because you know it's going to fall in value. Short position on the Forex pair GBP USD. No, you won't go short, you go long. Because you need more USD to get 1 GBP, so you go long on that pair because that pair's going to fall. It's a short position. Yeah, it's a short position. No, it's going to be a long position because GBP slash USD is going to rise in value. So it's going to take more USD to get 1 GBP, so go long as it's going to go up. Yeah, that one. If you held shares in a local sugar mill company and the price of sugar dropped in your currency, which of these CFD trades do you likely want to make? Price of sugar drops in your country. Go short on sugar, go short on the sugar mill company. Yeah, because if the price of sugar falls, then the sugar mill company is going to fall as well, so go short on both. One share in ABC PLC costs $200 and you're confident that it will appreciate by $50. However, buying 10 shares would cost you $2,000, so you decide to trade the shares using CFDs instead. Your derivatives trading provider only requires 20% of the stock's value as the initial outlay for you to buy 1 CFD. So you open 10 standard contracts to open a long position. If the stock does appreciate by $50, you would have. So you're trying to buy 10 shares, so you only need 20%. So 20% of 2,000, no wait, 1 share 200. Only require 20%, so you only need a fifth of that, which is 40. 40 times by 10 shares is 400, so you would have put down $400. So put down $400, okay? And if the stock does appreciate by $50, so you won't lose anything, how much would you gain? So it's now selling for $250, right? $250. So 2,000. What's 250 times by 10? 2,500. 2,500 minus 2,000 is 500. So put down 400 and got back 500. You own 200 shares in XYZ PLC worth $20,000 in total. $20,000 in total. Each share is worth $100. You open a short position on 15 standard CFDs. One share costs $100 and you put down a 20% margin to open your position. If the company share price increased by $25 by the time you close your CFD position, what would happen to your combined investment and trading portfolio? If the company share price increased by $25, so your shareholding would be worth, so each one is currently worth 100. Now they're worth 125. 125 times by 200. Let me get the calculator out. So 125 times by 200. 25,000. 25,000, so It's gone up by 5,000. Your shareholding would be worth 25,000. What would happen to your CFD position? So open a short position of 15 standard CFDs, but the price didn't go down, it went up instead. One share costs, and you put down, so put down a 20% margin. 100 times by 15 equals 1,500 times our 20%, which is 0.2. So you only put down 300. But it didn't fall, instead it rose. So it increased by 25. So now the share's worth 125 times by 15. So 1,875. So it's 187.5. I think it's that one. Right, because 100's increased by 25, so now it's worth 125 times by 15, which is 1,875 minus 100 times by 15, so that gets you $375. Oh no, it's a $375 loss, that one. You think company's B stock is going to drastically depreciate in the coming weeks. You own shares in the company, and this loss will greatly impact your investment portfolio. Which of the following actions are you likely to take to protect yourself? Sell your shares to avoid huge losses, take a short derivative position on company's B stock, both A and B. Take long CFD position, yeah, it's both A and B. Which of the following statements about leveraged derivatives is true? They enable you to trade shares by putting down a deposit on the full value of the trades. They amplify returns as well as your losses. It takes a long time to make a profit or loss from trading. No, it's only these two. 90, okay. So, CFDs are derivative instruments, while individual shares, commodities and bonds are assets that you can trade using derivatives. The value of your shares will drop by 10%, but because you took a short position anticipating that the market would fall, you would have made a profit from its movement. You place a sell trade or go short on the oil company you hold shares in, since news like this is likely to cause the oil company to drop value. Selling your existing shares may seem like a good decision to avoid major losses, but it requires careful consideration because some companies are more resilient than others and may bounce back quickly. You would expect an increase in the oil price to increase the transport company's costs, likely resulting in the company losing money and making lower profits. This could cause investors like you to sell their shares in the company to avoid losses, which will then result in a lower share price, because there's more supply than demand. However, your long CFD position would appreciate in value because going long on a trade means you expect the price of the underlying asset to increase. Because your long position was the oil price rising, you would have been able to close your trade with a profit made. A drop in the value of the USD would mean your shares are worth less in GBP than when you bought them. To cover this loss, you can take a long position on GBP USD to profit from the GBP's rise in value. This one. You only go short on sugar, you don't go short on a sugar mill company. If the price of sugar suddenly dropped, the value of your shares would fall. However, you'd still be able to capitalize on the change if you held a short CFD position on both the company and the commodity. If you held a short CFD position on both the company and the commodity, isn't that both the company, so both the sugar mill company and the commodity, which is sugar? So why do they mark this wrong then? I don't know. I thought I clicked that one. You would have put down only $400 on the 2,000 needed to buy the shares outright. In the end, your long position would have earned you the same $500 profit if you could have made by buying shares, but at a fraction of the cost. However, if the trade went against you, you would have also stand to lose more. 200 shares will now be worth $25 each, so that's $25 times by 200, which is 25,000. You would have lost $375 and not just $187.5 on your short CFD position. This is because you had full exposure to the market, even though you only paid a fraction of the full trade value. So your loss would have been on the full value of the trade and not just the 20% margin. Yep. A and B are both appropriate responses. However, if you're anticipating a future decrease in value, then opening a long position would mean you lose money should that happen. Short position is more logical choice, as you'd make a profit from any potential downturn. Both A and B are true, however it generally takes a short time to make a profit or loss when trading derivatives due to market volatility, so C is not true. Nice. So that's that course done. Now on to the more advanced ones, understanding risk and reward. So while new traders tend to think about how much money they can make, those with experience know it's much more important to focus on what they could potentially lose. As a trader, you'll inevitably have some positions that don't go to plan, but if you prepare for these situations and respond wisely, they shouldn't hinder your long-term success. In this course, we'll run through 5 simple rules that you can follow to help you manage the risks of trading and manage your profitability. Cool, so planning your exit. Planning your exit. Date is the 23rd. Start off with a nice little video. Okay, nice bit of warning here.
One of the biggest differences between new traders and experienced professionals is that very often a new trader thinks about how much money they might be able to make, while professionals tend to focus on how much they might possibly lose. So if you trade for long enough, you're going to have losing positions. No human being can see into the future. So professional and new traders alike will have to contend with losing trades. But it's how the trader prepares for and responds to those losing situations that will often differentiate those who see long-term success from those that don't. In this video, we're going to share 5 rules of money management that you can adopt to help you manage the risks of trading more effectively. First, plan your exit, where you'll get out if this trade doesn't go well. Emotions can run very high during the ups and downs of trading. Watching your hard-earned money disappear as a losing trade depletes equity from your account can be an uncomfortable experience, and it can compromise your decision-making abilities. So the first step before even entering a trade is to determine where you'll get out if this idea goes wrong. You need an exit plan, a strategy for managing the risk of the position so that one bad trade won't wipe out a significant chunk of your trading capital. But simply telling yourself where you want to get out may not be enough. Markets could move overnight or while you don't have access to your trading platform. So you should not only decide where you'll close a trade, but set a stop loss order to do it automatically. And that's our second rule. Get a stop. Reinforce your exit strategy with resting order. It's easy to but especially when you're new to the markets and still feelings created by a losing trade can have a substantial impact on your next trade. Even worse is something that's likely to happen to you at some point, watching a winning trade turn into a loser. You keep on hoping for recovery as the position dries below your entry price. That hope turns to wishful thinking as prices continue to deteriorate. And then it's followed by desperation when it becomes clear that prices probably aren't coming back, at least not anytime soon, and you'll have to realize a loss. In this situation, the financial loss on the position certainly stings, but it's the emotional toll that can make your next trade more complicated as you try to recover. Just one idea that didn't work out could define how you move forward in a market. One easy way to help avoid this issue is to decide where to set your stop before opening a position and set it up while executing the trade so your trade is never left unprotected. With a stop loss order in place at a predefined exit level, if that price is met, you don't have to make a decision about what to do. You've done your planning in advance and your position is closed for you. Our next rule is calculate your risk-reward ratio. Make the risk to your capital worthwhile. Your risk-reward ratio is the amount of risk you're taking on in a trade compared to the amount of potential reward. This is an area where lots of new traders falter. They begin with the belief that they have to beat the market or outpredict other traders in order to become more profitable. There's just one problem with that. It's impossible to predict the future, no matter how much knowledge and experience you have. So instead of fixating on winning more, professional traders will usually focus heavily on their risk, ensuring that every dollar or pound put on the table as risk capital is worthwhile in terms of potential return. To illustrate why, let's look at an example of a coin flip. When you toss a coin and make a guess, you have a 50% chance of being correct. Now, if you lose £1 when you're wrong and make £1 when you're right, you're moving towards breaking even. But as a trader, you're not quite there for costs like spreads, slippage, or commissions. So even with this arrangement over the long term, you'll probably lose money. You could remedy that in one of two ways. First, you could make sure you win on a higher percentage of coin flips, but unfortunately that's impossible. The odds are what they are. So the alternative is to win more when you're right than you lose when you're wrong. Many traders try to take the first option and win a higher percentage of trades, but although this may seem easier than trying to beat the odds at coin flips, it can still prove very hard to do over the long run. A much more proactive approach is the second option. Look for a bigger reward if you're right than you might lose if you're wrong. This is known as a positive risk-reward ratio. Returning to our coin flip analogy, now imagine you lose £1 when you're wrong, but make £2 when you're right. This would be a 1 to 2 risk-reward ratio. If you're right 50% of the time, the extra profit you make will more than offset what you lose when you're wrong. In the same way, if you trade with a 1 to 2 risk-reward ratio, you can be profitable by only being right 50% of the time. In fact, 40% of the time, you can still be profitable. If you flipped the coin 10 times, you'd lose £6 from your 6 failures, but make £8 from your 4 successes. Let's move on to rule 4, control your risk amount. Following the first 3 rules will begin to help you manage risk in your trading activities, but these steps alone won't protect you from the risks that any single bad trade could wipe out your trading account if you risk too much on any single idea. Suppose you trade euro-dollar, setting a protective stop-loss order at 100 pips and a limit 200 pips away. Could you still blow up your account? Yes, absolutely. If a move of 100 pips equates to 50% or more of your trading account, just that one trade could erase a significant portion of your equity if things go wrong. Let's go back to our coin flip example. Suppose you hit a run of bad luck and lose 5 consecutive flips. What happens if each successive flip erases 50% of your remaining equity? Say you start with £10,000 in equity. After 5 flips, you'll only have £625 remaining. That's a net drawdown of 93.75%, all because of 5 cases of bad luck. To get back your original £10,000, you'd need to generate a return of 15,000%, since you're now starting from such a small base. Unfortunately, this isn't likely to happen. Now, you can avoid this situation by controlling the risk amount on each individual trade setup. Many professional traders will keep their risk amount per individual trade idea to less than 1% of their account equity. That way, if any given trade idea doesn't work out, the most they stand to lose from it will still leave them with 99% or more of their account equity intact. If you risk 1% per trade with a 1 to 2 risk to reward ratio, you can potentially make 2% if the trade works out. For newer traders, it's a good idea to start with smaller amounts, but at no time should you risk more than 5% on any given idea. Frankly, markets are unpredictable, and even the most carefully planned trade can go wrong. And that brings us to our last rule. Obey all of the rules always. One of the great things about trading the markets is that every day has the potential to bring something new. It's what makes trading exciting, but it also means that a good trader needs to maintain get engrossed in a situation or a trade while losing sight of the bigger picture. So, if you want to become a successful trader, look at the markets as a business. Be pragmatic, manage your own expectations and plan your strategy, always following our 5 rules. That might not sound very exciting in itself, but it will let you focus on what really is exciting, staying on top of the market. To recap, our 5 rules are: plan how you'll exit a trade before you enter it. Set a stop when you open a position so you have protection right from the outset. Look for positive risk-reward ratios because nobody has a crystal ball and you can't win every trade. Never risk more than 5% of your equity on any single trade idea. 5, obey all of the rules, always. That concludes our video on money management. Thank you for watching and best of luck in your trading.
Okay, so that was the 5 rules, or 4 rules rather. The 5th one was just telling you to follow all the rules. So yeah, since no human can see into the future, unfortunately new and experienced traders alike will sometimes have to contend with losing trades. Emotions can run high at these times. Watching your hard-earned money being depleted from your account is an uncomfortable experience, and it can compromise your decision-making abilities. That's why it's important to decide right from the outset where you get out if this trade doesn't work well. So, rule number 1. Always have an exit strategy. Always have an exit strategy. You need an exit plan, a strategy for managing the risk of the position so that one bad trade won't wipe out a significant chunk of your trading capital. But simply telling yourself where you want to get out may not be enough. Consider the scenario. You head for bed for the night and with the position going well, but by the time you wake up in the morning, the market has taken a turn against you. Or perhaps you're watching a position while travelling on the train. Enter an area of no mobile or Wi-Fi service, and by the time you get back online, the market has moved past your planned exit level. So once you've decided where you'll close the trade, you need an automated mechanism to protect you when you're not in control. And that's our second rule. So always have an exit strategy. So you need an exit plan, which is a strategy for managing the risk of the position so that one bad trade won't wipe out a significant chunk of your trading capital. Wipe out a significant chunk of your trading capital. Once you've decided where you'll close the trade, you need an automated stop mechanism to protect you when you're not in control. That's our second rule. Set a stop. Rule 2. Set a stop. Setting a stop reinforces your exit strategy. The resting order will close your position if the market hits the level you specify, even if you're not logged into your platform at the time. So, setting a stop reinforces your exit strategy. The resting order will close your position if the market hits a level specified. If the market hits the level you specify, even if you're not logged in to your trading platform at the time. It also removes the need for you to make a difficult decision under pressure. It removes the need for you to make a decision, make a difficult decision. Oh my, decision under pressure, under pressure, under pressure. It's a level. It's easy to disregard the emotional aspect of trading, but especially when you're new to markets and still learning, the roller coaster of feelings created by losing a trade can have a substantial impact. So, when you're new to trading, the roller coaster of feelings created by losing a trade can have a substantial impact. Example: let's say you take a long position and the market immediately starts to rise. So when you're hoping the market's going to rise, so it starts going to rise, putting you to profit. However, suddenly it goes back into a sharp reversal. So here's your entry, it goes to rise, you're happy. However, suddenly goes to sharp reversal, bam. Then to your dismay, your winning trade rapidly turns into a loser. As the position drives further below your entry price, you keep hoping for recovery, but that hope turns into wishful thinking as price continues to deteriorate. Finally, you're left with a feeling of desperation. It's clear that prices aren't coming back anytime soon, and you have no choice but to realize a loss. In this situation, the financial impact certainly stings, but it's the emotional toll that can make your next trade more complicated. As you try to recover, just one idea that didn't work out could define how you move forward in a market. For example, you might feel tempted to rush into a new position without proper consideration, in an effort to claw back your losses as quickly as possible. One easy way to avoid this issue is to decide where to set your stop before opening a position, and set it while executing the trade so your position is never left unprotected. With a stop loss order in place at your predefined exit level, if the price is met, you don't have to make a decision about what to do. You've done your planning in advance and your position is closed for you. Lesson summary: every trader needs to be prepared to suffer some losses. Always plan where you exit a trade if it doesn't go well, and set a stop to close the position automatically for you. So every trader needs to be prepared to suffer some losses. Balancing risk and reward. So balancing risk and reward. So, as we know, all trading involves the risk of loss. So in every trade, the risk to your capital needs to be worthwhile for you in relation to the potential profits. Rule number 3, calculate your risk versus reward ratio. Calculate your risk versus reward ratio. You can use the risk versus reward ratio to quantify the worthy of a trade. Can use the risk versus reward ratio to quantify the worth of a trade. Your risk versus reward ratio is the amount of risk you're willing to take on in the trade compared to the amount of potential reward. Risk versus reward ratio is the amount of risk you're taking on in a trade compared to the amount of potential reward. This is an area where lots of new traders falter. They begin with the belief that they have to beat the market or outpredict other traders in order to become profitable. There's just one problem with that. It's impossible to predict the future no matter how much knowledge and experience you have. So instead of fixating on winning more, professional traders will usually focus heavily on their risk, ensuring that every pound, dollar, etc. put onto the table as risk capital is worthwhile in terms of the potential return. Instead of focusing on winning more, focus on your risk so that it's worthwhile in terms of the return. In terms of the potential return. To illustrate why, let's look at an example. So I think this is a coin analysis. Yep. Imagine a game of flipping a coin where you have to guess the results. On each toss of the coin, you have 50% chance of your guess being correct. Now, if you lose £1 when you're wrong and make £1 when you're right, you're moving towards breaking even. But as a trader, you're not quite there yet, as you need to account for costs like spread, slippage, or commissions. So even with this arrangement, over the long term, you'll probably lose money. You could remedy that in two ways. First, you can make sure you win on a higher percentage of coin flips, but unfortunately that's impossible. The odds are what they are. So the alternative is to win more when you're right than you lose when you're wrong. Many traders try to take the first option and win a higher percentage of trades, but although this may seem easier than trying to beat the odds at the coin flips, it can still prove very hard to do over the long run. Many traders try to take the first option and win a higher percentage of trades, but although this may seem easier than trying to beat the odds at coin flips, it can still prove very hard to do over the long run. A much more proactive approach is the second option. Look for a bigger reward if you're right than you might lose if you're wrong. This is known as a positive risk versus reward ratio. Positive risk versus reward ratio is looking for bigger reward if you're right than you might lose if you're wrong. This is known as a positive risk versus reward ratio. Returning to our coin flip analogy. Now imagine you lose £1 when you're wrong, but you make £2 when you're right. This would be a 1 to 2 risk versus reward ratio because you're risking £1 to win £2. If you're right 50% of the time, the extra profit you make will more than offset what you lose when you're wrong. In the same way, if you trade with a 1 to 2 risk versus reward ratio, you can be profitable by only being right 50% of the time. You can achieve this by setting your stops and limits at the appropriate levels. 2 times stop distance. Your entry, your limit. So this is where you're hoping the price is going to go down, right? Yeah, because you're shorting this position. So your limit is 2 times whatever your stop loss distance is from entry. So your risk is this distance here, x, and your reward is this distance here, 2x. So that makes sense. You can achieve this by setting your stops and limits at the appropriate levels. And in fact, even if you're only right 40% of the time, you can still be profitable with this 1 to 2 ratio. If you flip the coin 10 times, you lose £6 from your 6 failures, but you make £8 from your 4 successes. Did you know, in a 12-month study of traders' behavior and the factors affecting their success, we found that those who implemented a positive risk versus reward ratio were almost 3 times more likely to be profitable than those who use a negative ratio. Percentage of traders net profitable for the year. Risk to reward ratio of less than 1 to 1, 19%. Risk to reward ratio of 1 to 1 or more, 51%. Source: IG group accounts and trades, excluding clearing accounts, money managers and eligible contract participants. 1st of January to 31st of December 2016 across 15 of the most traded markets. So 1 year worth of data. Risk to reward ratio of less than 1 to 1. Risk to reward ratio of 1 to 1 or more. Percentage of traders net profitable for the year. Percentage of traders net profitable for the year. So 19% are profitable, whereas 51%. So even if they're using a risk to reward ratio of more than 1, only half of them were profitable. Suppose you open a trade with a limit order 300 pips away from your entry level. To achieve a 1 to 2 risk versus reward ratio, how many pips away from the entry price should you set your stop? Limit order 300 divided by 2, because this is your reward. Reward is 2, your risk must be half of that, which is 150. The stop order should be half the distance of the limit to ensure your possible loss is half the amount of your potential profits. Bear in mind that you need to use a guaranteed stop if you want to ensure your position is closed at precisely the level you specify with no slippage. You can learn more about the different types of stops in our orders, execution and leverage course. So remember that guaranteed stops must be used if you want to close at a precise level without slippage. So let's a summary. The risk to your capital should be outweighed by the potential profit on a trade. Your goal is to gain more if you're right than you might lose if you're wrong. Using a 1 to 2 risk versus reward ratio means you can be profitable even if you're only right 40% of the time. Set your limit order at twice the distance of your stop to achieve a 1 to 2 ratio. Set your limit order at twice the distance of your stop to achieve a 1 to 2 ratio. And then if you set it 3 times, then that's a 1 to 3 ratio, 4 times 1 to 4 ratio, and so on. But remember, they're going to be harder. The take profit limits are going to be harder to hit than, say, a 1 to 2 risk reward ratio. So yeah, okay. I'm going to leave this episode here then. So in the next video we're going to go through controlling risk. So yeah, thank you all for watching. See ya.